Welcome to the Byte-Size Brief. Today, we are putting the Goldman Sachs Group Inc., GS, that's GS, completely under the microscope. Let's get into it. Imagine missing your quarterly revenue targets by nearly $1 billion
Right.
and shutting down this highly publicized consumer banking project at a massive loss, and somehow your stock price still explodes to all-time highs.
Yeah, it sounds completely counterintuitive.
Exactly. But that is exactly the reality right now for this firm, because 2025 was just an absolute monster of a year for Wall Street, and the subject of today's deep dive is sitting right at the center of this massive financial whirlwind.
And the underlying mechanics of that whirlwind are really what make this such a fascinating case study. Just to, establish the baseline data we're working with today, the firm closed out 2025 as its most profitable year in recent history.
Oh, wow.
Yeah, we are looking at $58.28 billion in net revenues for the full year.
That's just a staggering number.
It is. And out of that top-line number, they pulled in an impressive $17.18 billion in net earnings.
Right.
And if you look at the market's reaction, as of late March 2026, the stock price is hovering right around the $830 mark.
Which is just a historic run. And I think that brings us to our core mission for today's deep dive. If you're a retail investor listening to this right now, staring at that $813 share price, you are probably asking yourself a crucial question.
Right, the big question.
Yeah, we want to figure out, is this historic run just a cyclical peak, meaning, they're riding a macroeconomic wave that is destined to crash? Or is this the foundation of a structurally stronger, leaner financial powerhouse that's actually built to last?
Well, to answer that, we really have to look at the engine room of their business model.
Right.
To understand those record 2025 numbers, you first have to look at how the Goldman Sachs Group, Inc., GS, makes its biggest headlines, and that is mergers and acquisitions.
M&A.
Exactly, M&A. In 2025, they didn't just participate in the global M&A market, they dominated it, capturing a 32% global market share.
Wait, 32%? Just them?
Just them. They advised on $1.48 trillion in corporate deals.
A trillion. With a T. I mean, that is essentially the gross domestic product of a mid-sized country moving through their advisory desks in a single year.
Yeah, and from that $1.48 trillion in volume, they extracted $4.6 billion in pure advisory fees. To give you a sense of how dominant that actually is, consider their closest benchmark, Morgan Stanley, which sat at $1.14 trillion in deal volume.
Okay, so they're significantly ahead.
Right. They are leading the pack by a staggering margin. And their deal backlog, meaning the pipeline of signed but unclosed transactions, it's currently sitting at a 4-year high.
So they have this massive waiting list of deals just waiting to print cash. But let's dig into the why here. What is actually driving this sudden, explosive corporate matchmaking? Because a 4-year high in the backlog doesn't just happen by accident.
No, it doesn't.
Yeah.
CEO David Solomon has publicly categorized this as a deal-making renaissance.
Oh, a renaissance, all
yeah,
right.
and the catalyst driving it is what he calls the AI innovation supercycle. And this is where the narrative gets incredibly interesting. Well, this M&A boom is not just Microsoft buying another AI startup or Google acquiring a machine learning team. The boom has broadened out into the physical world.
The physical world, like hardware.
Hardware, yes, but even more fundamental. We are seeing legacy industrial companies scrambling to acquire AI software capabilities. But more importantly, we are seeing massive tech giants acquiring power infrastructure companies and data center real estate trusts.
Oh, just to get the electricity.
Exactly, simply to secure the electrical grids required to run their servers.
So basically, it's kind of like the Goldman Sachs Group, Inc., GS, has set up the ultimate toll booth on the AI innovation highway.
That's a great way to look at it.
Because if a Silicon Valley tech giant realizes they need to buy a 50-year-old utility company in Ohio to power their new AI server farm, they don't have the internal expertise to value that utility company, right?
Right.
So they have to drive through that toll booth, utilize their institutional trust and valuation models, and, pay a massive advisory fee to make the deal happen.
And that toll booth is incredibly lucrative right now. The structural advantage they have is decades of deep relationships across every traditional sector, energy, industrials, real estate.
Right, the tech guys just have the cash.
Precisely. Tech companies have the capital, but the Goldman Sachs Group, Inc., GS, has the network to facilitate the physical infrastructure acquisitions that AI actually demands. But, and this is a big but, anyone looking at this stock needs to understand the inherent cyclical risk.
Right, because what goes up on Wall Street usually comes down. And investment banking is famously boom and bust.
Very much so. That 4-year high backlog is fundamentally hostage to the macro environment. If the Federal Reserve suddenly shifts posture and interest rates spike unexpectedly, making borrowing incredibly expensive,
Deal-making stalls?
corporate deal-making will stall instantly. Or if regulatory bodies like the FTC suddenly tighten antitrust oversight and block these massive tech utility mergers, those advisory fees disappear. Or if the AI capital expenditure bubble simply bursts, that entire backlog could evaporate almost overnight. We saw the exact same dynamic in 2022 when deal flow essentially froze in place.
Okay, so compared to last quarter, what actually moved the needle here? Because having a stuffed pipeline of future deals is great, but how did that actually translate to the balance sheet in the most recent reporting period?
Well, this brings us to the fascinating paradox of their Q4 2025 earnings report. The firm actually missed top-line market revenue expectations by over 7%.
Oh, wow.
Yeah. Wall Street analysts estimated they would bring in roughly $14.49 billion for the quarter, and they only delivered $13.45 billion.
That's a pretty significant miss.
It is. Yet despite missing on revenue, they delivered a massive 20.6% earnings surprise.
Wait, what?
Their earnings per share, or EPS, came in at $14.01, completely shattering the $11.62 consensus.
If you're listening to this and wondering how that math works, like, how do you make nearly $1 billion less in overall revenue, but take home 20% more profit per share than anyone expected? It honestly sounds like a magic trick.
It's not magic, I promise. It is a masterclass in internal restructuring and finding ruthless efficiencies. To understand the EPS spike, we first have to look at the divisions that fired on all cylinders.
Okay, let's break that down.
Equities trading rocketed up 25% year over year, bringing in $4.31 billion for the quarter.
Huge.
And investment banking fees also jumped 25% to $2.58 billion. They were generating highly profitable, high-margin revenue streams on the institutional side.
Hold on, how does that actually affect the Goldman Sachs Group, Inc., GS's stock price for regular investors like me? Because if I own a small business and my total revenue drops by 7%, I'm panicking.
Yeah.
Why does Wall Street reward a revenue drop by pushing the stock to $813?
It's a great question. Wall Street rewards mature financial institutions for profitability over pure scale. It honestly does not matter how much money flows through your hands if you cannot keep any of it.
Right.
By dramatically improving their profit margins, the firm managed to drive an annualized return on equity, or ROE, of 16.0% for the quarter.
Let's ground that 16% ROE for a second. If you have a high-yield savings account right now, you might be thrilled to get a 4 or 5% return on your money.
Exactly.
But the Goldman Sachs Group, Inc., GS, is generating 16 cents of pure profit annually for every dollar of shareholder equity sitting on their balance sheet.
Yeah.
That is just incredibly efficient.
That level of capital efficiency is exactly what institutional investors are buying. But to achieve that 16% ROE while missing top-line revenue, they had to aggressively trim the fat from their operations.
Ah, the cutbacks.
Right. And they did that by finally ending their most public recent failure. The data details the definitive end of the Marcus consumer banking experiment.
Oh, Marcus. The grand multi-year plan to bring elite Wall Street banking to everyday Main Street consumers. I mean, they wanted everyone's checking accounts, savings accounts, personal loans, everything.
And it turned into a massive financial sinkhole. To give you context on the cash burn, the Marcus project burned through $1.2 billion in the year 2022 alone.
Just completely set on fire.
Essentially, yes. The firm is now fully retreating from its ambition to be a large-scale digital retail bank. And those weird Q4 numbers we just discussed, the revenue miss combined with the earnings spike, were massively impacted by their transition out of the Apple Card portfolio.
Walk us through the mechanics of that, because how does losing a massive credit card partnership boost your earnings? That sounds backwards.
It comes down to banking regulations and capital requirements. When a bank issues consumer credit like the Apple Card, regulators require them to hold a significant amount of cash in reserve against those loans.
Just in case the consumers default.
Exactly.
Yeah.
That cash is essentially trapped. It cannot be invested, and it cannot be returned to shareholders. So when they finally structured their exit from the Apple Card partnership, they took a $2.3 billion reduction in revenue.
Okay, so that explains the revenue drop.
Yes. But because they were no longer holding those risky consumer loans, they were legally allowed to release $2.5 billion in trapped cash reserves.
So the revenue drops because they aren't collecting credit card interest anymore, but the profit and available capital spike because they just unlocked $2.5 billion from the regulatory vault.
Precisely.
So basically, it's kind of like realizing you are a terrible day trader, taking your massive loss on the chin and pulling all your remaining cash out to put it into the index funds you actually understand how to run.
That is a very accurate analogy.
Mm.
They recognized that acquiring retail consumers and managing small dollar credit risk was simply not their core competency. So they took the reputational hit, stopped the cash bleed, and pivoted those resources entirely into what they do best. Yeah. They're calling this new refocused strategy the One Goldman Sachs 3.0 initiative.
One Goldman Sachs 3.0. I mean, it sounds like a software update for a bank.
In many ways, it is. The strategy is heavily powered by an internal automation tool called Ella AI. Instead of spending billions trying to acquire regular retail checking accounts, they're redirecting all that technological power and human capital to their Asset and Wealth Management Division, or AWM.
Okay.
They have set a new, highly aggressive pre-tax margin target of 30% for this division.
30% pre-tax margins in wealth management is astronomically high. You don't get that by managing regular people's retirement accounts.
You don't.
You get that by catering to the ultra-wealthy and massive institutions.
Which is exactly their target demographic. They are retreating entirely back to B2B services, ultra-high net worth individuals, and alternative investments.
Give us an example.
Well, for instance, they recently acquired Industry Ventures, which immediately added $7 billion in venture assets to their platform. They also announced a massive goal of managing $300 billion in private credit by 2029.
Let's unpack private credit for a second, because that's huge. Instead of a massive corporation going to the public bond market and dealing with all that regulatory headache to raise money, they just go directly to the Goldman Sachs Group, Inc., GS, for a bespoke billion-dollar private loan.
Exactly.
The interest rates are higher, the terms are stricter, and the margins for the bank are massive. That is exactly what shareholders want to see them doing.
So if we look at the entire picture thus far, the consumer banking bleed has officially been stopped.
Check.
The M&A advisory fees are flooding in from the AI infrastructure supercycle.
Check.
And they just unlocked billions in regulatory reserves from the Apple Card exit.
Right, which creates a very specific quote-unquote problem for a financial institution. They're sitting on an absolute mountain of excess cash.
A very good problem to have.
Definitely. So what are they doing with it? And more importantly, what are their own internal traders buying right now?
Well, first off, they are firing up the cash cannon and returning it directly to shareholders. The capital return metrics are genuinely staggering. First, the firm raised its quarterly dividend by 50% to $4.50 a share.
50%.
Yeah, that translates to an $18 annual run rate, currently yielding around 2.22%.
A 50% dividend hike is a massive signal of confidence from the board of directors. But, I mean, dividends are just the appetizer. The buybacks are the main course here, right?
They are. The firm currently have $32 billion remaining in their active share buyback authorization. And they just announced an additional historic $40 billion buyback program scheduled for post-Q1 2026.
So if you want to understand why the stock is sitting at $813, look no further than a combined $72 billion in buyback power.
Exactly.
When a company buys its own stock, it's like a pizza with fewer slices. Every remaining slice represents a larger portion of the underlying pie. It artificially boosts the earnings per share because there are simply fewer shares in existence.
It's pure financial physics.
Right. It puts a massive floor under the stock price because the firm itself is the biggest, most relentless buyer in the market. But I'm curious about the trading desk. With all this AI talk and macro shifting, how is the GDES trading desk playing the 2026 economy?
Their internal desk has laid out a highly specific AI trading playbook with 3 top equity trades for the year.
Let's hear them.
Trade number 1, going long on non-tech companies that are actively using AI to boost productivity.
Interesting.
Yeah, they're looking past the chip makers and hardware designers and focusing on legacy companies utilizing AI software to drastically cut their operational costs and expand their margins.
So find the companies actually saving money with the tech, not just building the hype. That makes perfect sense. What is the second trade?
Trade number 2 is rooted in a sobering macroeconomic view. They are shorting low-income discretionary consumer stocks. Their internal economic models are modeling a persistent K-shaped economic recovery.
A K-shaped recovery. Let's break that down for everyone.
Yeah.
The wealthy are riding the top arm of the K upward, right? Benefiting from skyrocketing asset prices, real estate, and, 16% bank ROEs.
Yes.
Meanwhile, lower income consumers are sliding down the bottom arm of the K, getting crushed by sticky inflation, high grocery bills, and elevated borrowing costs. So the trading desk is actively betting against companies that rely on lower income Americans buying non-essential goods. It is a ruthless strategy.
It is ruthless, but it's purely objective based on the data. Trade number 3 is a pairs trade within the AI sector itself.
Okay.
They are going long on high-margin, cash flow positive AI stocks,
Right.
while simultaneously shorting vulnerable AI stocks that have weak fundamentals.
For those listening who might not trade professionally, a pairs trade is when you buy one company and short another company in the exact same industry to eliminate broad market risk. You are just betting that company A will outperform company B. So they are betting that the market is going to stop rewarding every single startup with AI in its pitch deck and start demanding actual provable cash flow. It's the end of the hype phase and the beginning of the show me the money phase.
And this level of precise thematic trading is exactly why the firm's FICC division, that is, fixed income, currencies, and commodities, along with their equities financing business, hit a record $11.4 billion in 2025.
Incredible.
They are the undisputed masters of navigating these market disparities, providing the financing and prime brokerage services to the massive hedge funds executing these exact same complex trades.
So they're making money on their own trades and making money charging fees to hedge funds making the same trades.
That's the model.
The financial picture is just crystal clear. Record profits, unprecedented efficiencies, massive capital returns. But, and I think we need to pivot here, these massive infrastructure deals and complex pairs trades don't just execute themselves.
No, they don't.
We need to talk about the human cost. Who is actually grinding out the thousands of pages of pitch decks for these $1.48 trillion in M&A deals?
Well, the internal culture of the firm has recently become the subject of intense public scrutiny, specifically regarding the junior workforce.
Yeah, you literally cannot ignore the recent viral leaks coming out of Reddit, specifically the ordered Goldman Sachs subreddit and forums like Wall Street Oasis. We are talking about junior analysts reporting absolutely brutal, unsustainable working conditions.
Particularly over the healthcare group.
Yes, the sources describe this intensely performative culture where junior bankers are operating on like 45 minutes of sleep. They are expected to receive pitch deck comments from managing directors at 2 a.m. and have the revised deck ready by 6 a.m.
And this is occurring despite the firm implementing official, mandated curfews intended to protect junior staff downtime and ensure adequate rest.
But the leaks explicitly claim those curfews are purely for public relations optics. Like if you log off at midnight, you are quietly penalized in your bonus review. And the most fascinating part of these leaks is how the analysts categorize their own ranks. They say the junior workforce falls into 3 distinct buckets. First, the savvy planners, the ones who know the job is a brutal grind, but are meticulously planning their exit to a private equity firm after 2 years.
A stepping stone.
Right. Second, the Kool-Aid drinkers, the ones who fully adopt the firm's ruthless culture as their entire personality and are gunning for partner. And third, you have what they literally refer to as the cannon fodder.
Right, the individuals who join simply for the prestige of the name on their resume without a real survival strategy. According to the internal sources, they get completely brutalized by the workload and wash out very quickly.
So my question is, if you burn out your best, brightest young talent, won't they just take their elite training and their Rolodex of contacts down the street to a boutique advisory firm that actually lets them sleep? Like, doesn't a toxic culture eventually bleed into the balance sheet as execution risk?
Look, talent retention is a genuine execution risk, but the corporate counterweight to these viral leaks is staggering. Despite the very public knowledge of the grueling hours and the 2 a.m. deck revisions, the firm received over 1.1 million applications for experienced hires in 2025.
Wait, over 1 million applications from people who already have experience and know exactly what they're signing up for?
Yes, and that application volume is actually up 33% year over year. Furthermore, their incoming intern selection rate remains fiercely competitive, sitting well below 1%.
That's wild.
The cold reality is that the firm's prestige, the unparalleled compensation ceiling, and the elite exit opportunities provide an endless global pipeline of highly capable talent. For every exhausted analyst who burns out and leaves the desk, there are 1,000 pristine resumes waiting to take their chair.
Wow.
They're entirely willing to endure the gauntlet for the brand equity provides.
1.1 million people raising their hands saying, put me in the gauntlet. It really highlights a fascinating, almost dark irony connecting everything we've talked about today.
How so?
You have these exhausted junior analysts complaining on Reddit about turning around formatting comments on M&A pitch decks at 2 a.m. But with the firm's new rollout of One Goldman Sachs 3.0, they are aggressively utilizing Ella AI to automate their internal efficiencies and drive that 30% margin target.
I see where you're going.
Right. Those exhausted junior analysts might very soon find themselves competing for their jobs against the exact same AI models they are helping the firm raise capital to deploy.
It is the ultimate double-edged sword of the innovation supercycle. The same technology driving their record profits and M&A advisory fees could very well restructure the human foundation of the firm itself.
It is just an incredible amount of information to digest. I mean, we have historic profitability driven by a retreat from consumer banking, ruthless capital efficiency, a massive $40 billion buyback floor, and a human toll that is offset by an endless line of applicants. All right, listeners, what's your take on the future of the Goldman Sachs Group, Inc., GS? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.